the LAProbate expert, and I am hosting today our Tuesday real estate investing Zoom, where we get together every week and talk about all things real estate investment, from brand new agents, brand new looking to invest, wholesalers, bird doggers, to experienced investors looking for deals, to vendors. We talk about all things real estate investment. And I'm really excited to have today, one of the things I get asked a lot is, well, where do I start? And what can I do to lock into a system or process to help me go from zero to making a living at this? I did it, but I started in 1986. And I think you have to have three things to be successful when you start off. You have to have a leader or a coach or some sort of a person at the front of the pack. You need to have a system or process or a book. I think you have to have colleagues and team members who are with you along the way. So I'm always looking for answers to that question. I came across a guy last week who I think is really, I was really impressed with his knowledge of the real estate market, really impressed with his position in the industry overall and his colleagues. And so I wanted to invite Matt Picheny to our call today. Matt, welcome to our call today.
Hi, thanks for having me.
I think you're muted there.
Am I muted? Give me 1 second then. Let me just.
I don't have any. Hold on. You know what it is you're coming in on the Restream. You're not coming in on the Zoom.
Oh.
You need to have the Zoom link. That's the problem.
So
the Restream link you have is
in?
For your social media.
Right.
I need you to come in on the Zoom link.
Okay, give me
to come in
second.
to have the audio. Let me do this. Let me real quickly send you the text link.
I've got it.
Technical problems.
I've got it.
Sorry about that, everybody. Let's see. Where is David? And we talked, and I thought we worked through the technology, but my bad on not being clear instructions.
All right, so let me close the Restream.
There's that, and then there's this. Sorry about that. My bad.
I'm here.
How embarrassing. This is what real life looks like, though. I got to tell you. I was
for the host.
Okay. So, Matt, I just texted you a link to the Zoom. If you can.
Yeah, I'm in. I'm in it. You just need to let me in.
There you are.
I'm in. Yeah.
Let's see if I can find you.
There we go.
Technical issues, bad host. Sorry, everybody. But I'm going to add him to the spotlight. There you are. There we go. Matt, you have to unmute yourself. Welcome to our call.
Can I turn off the? Do I need to have the?
I think we got it.
There we go. I just turned off the Restream. I guess that's okay. I don't need.
Yeah. The Restream was
okay.
really more for you sharing social media. It wasn't really meant for you to come in on.
Sorry about that. It told me to log in. Anyway, glad I'm here. Sorry for the technical difficulties.
Welcome to. So after all that build up, Matt is a technical wizard. I'm a technical wizard. I've been doing this. I've been doing 2 Restreams minimum a week for all of COVID. So this is about episode 200 or so for us. But Matt, glad to have you on. And I know I met you on a recent multifamily investment program. We talked about looking for passive income. Give us a little background. How did you get involved in, where'd you grow up, and then how you get started in business, and how did you get into your search for passive income?
Sure. I grew up in Orlando, Florida, actually. That's where I'm from. And I moved, I started getting involved in theatrical endeavors in Florida. It was something that I enjoyed doing. I was involved in community theater. I actually worked at Walt Disney World as a child, worked there, and just had a lot of fun doing it. Really enjoyed that. So I decided to move to New York City once I graduated high school and pursue a career in theater. And so I moved to New York, and I went to a musical theater conservatory, graduated from there. I was a professional actor for 5 years. I was in 15 different professional productions throughout the country. And I started doing some computer work. I know there was that little technical difficulty earlier, but I'm pretty good with computers. I did some computer work and got involved in digital marketing. And I actually started my own company doing digital marketing back in the mid 90s, right in the heydays of the .com era. So I had a little boutique agency doing that work. And about 5 years later, along came 2001 and the .com bubble burst. And a lot of my clients were going out of business or not spending money on digital marketing efforts, and my business was imploding. And right at that time, my landlord gave me a call and told me I had 90 days to get out of the apartment I was living in. So it was not great timing, and it was quite a daunting task to, wanted to stay in New York, wanted to find a place to live, but also didn't have really a job or any income. And because the dot-com bubble had burst, there was nobody really hiring in the digital marketing world. But I ended up getting a job at Showtime, the cable television channel. They were a client of mine, and they offered me a position to go in-house. And instead of renting an apartment, I ended up buying a co-op apartment in a different part of town, not the part of town that I wanted to live in, but a decent part of town. And about a little over 2 years later, I sold that apartment and saw my initial equity investment in that deal more than quadruple in value. And that was the big light bulb moment for me, that I really wanted to figure out, how do I do that again? I mean, I was making a good salary at that time, but the amount of money that I made on that one transaction was more than my salary for the entire year. So that was something that I really wanted to try to figure out, how can I repeat that? And I spent the next 10 years doing it as a hobby. Real estate, I would do different things. And then about 6.5 years ago, I transitioned to moving from real estate as a hobby to real estate as a full-time job. And so I am now a full-time real estate investor. So I 2/3 of my portfolio are deals that I invest in from a passive perspective as a limited partner. 1/3 of my portfolio are deals that I manage. I'm an asset manager. I'm the general partner on those. That's what brings us to today.
Now, I know, among other things, you also have written a book on the subject of passive income. Tell us a little bit about the book that you wrote.
Yeah, so I wrote a book up there. It is on the screen. Backstage Guide to Real
It's
Estate.
magic.
Backstage Guide to Real Estate is about my journey from, someone who knew absolutely nothing about real estate, a complete novice, just leaving the acting world, all the way to where I am now, an owner of thousands of apartment units across the country. I share with the reader the different things that I learned along my path. So there's 18 different keystone concepts that I share with the reader that I learned along my journey. There's also 60 different real estate terms that are defined in the book. But it's a interesting book written in sort of a memoir style, and it's fun and interesting, probably different than any other real estate book you'll ever read. I mean, there's good hard facts in there, right? And it's an educational book, but there's a lot of, I think, humor and entertainment surrounding all of that, the denser content.
So I'm sure, as I don't have the success you've had in real estate as an investor, but I've done all right. And I rarely get people who come to me and say, well, how do I get started? I want to invest. I have a good job. We've saved some money. We live in our means. We have extra to invest. But I have a job I have to tend to on a daily basis most of the time. I can't make a full-time job of it. Where do I get started? How do you answer that question? Where should I get started?
Well, that's exactly why I wrote this book, is for people who are interested in investing in real estate, but they're busy professionals. They have their own things that they need to do. They have their own lives. They have other things they need to tend to. And the impetus for this was I was running a meetup group, and it was for people who are interested in multifamily investment. A lot of them owned properties locally, but didn't own anything out of state and didn't own any large multifamilies. They had smaller multifamilies. And over the course of several years of me running this meetup and having different guests come and speak, and people started to get familiar with investing out of state in syndications like I was doing, some people decided to go ahead and take the leap. And they would reach out to me and say, hey, Matt, I know you invest passively in deals. I know you run some of your own deals. You run our meetup. Would you mind looking at this investment? I'm thinking about doing my first passive investment. And I would meet with them and to go over the underwriting with them and explain to them things that, I might question here or there. That would take an hour or two. And as my meetup grew and grew and grew, and more people were coming and asking me to do this, I was frankly losing hours in the day. Like I didn't have enough hours to do all of this. And that's why I wrote the book. I wrote this book as a way for people who are interested in investing passively in real estate to find out about it. And I decided I had originally written it as a way to just look at underwriting. And that was really dense and boring. And what I decided to do to make it more palatable to people was stretch it out along my journey. And there's still that analysis of the underwriting is like the back section of the book. I call it the backstage toolbox. But the whole rest of the book goes through my journey. And so my journey started with me knowing nothing and then buying an apartment to live in, and then buying a house that I turned into a rental, and then buying turnkey properties, doing some fix and flips, buying this townhouse in Brooklyn where we lived in one unit and rented out another. So I've really kind of run the gamut of a lot of the different things that you can do in real estate. And so by telling that story and about the different things that I did, I think people will find really good information in there. I found that what worked best for me is to start investing in these syndications. Because of the economies of scale, I can get really, really great returns. And in most cases, with 2/3 of my portfolio, I have to vet the sponsor, the person who's putting the deal together, and I have to vet the deal. And that's what this book shows you, how to do those things, what to look for. And then once I've done that, I can kind of just let it go and hope that I've done a good job with my vetting such that the returns will be at or close to what the initial projections were, right? And then I have another bunch of deals that I run on my own to my own group of investors. And I don't delve into that too much in the book. I do talk about my first deal and how that all went. It was a really fun and interesting story. But it's really written for people who are looking to invest passively, or want to invest in real estate, don't want to become an expert and do it full time, but realize that real estate is a great investment vehicle, that there's awesome tax advantages, and gives them enough information to be able to look at a deal and kind of decide if they think it makes sense or not.
So just for everybody on the call here today, I'm not like a RIA. I don't charge for this call. I don't charge the speaker for the call. I don't get a percentage. I don't get anything on the book. I just think he's a great guy, has a great message, great energy. I think there's a segment of people who are on my call who ask me, what can I do to invest in real estate, that he has an answer to or a path towards the answer to. So if you have questions, put them in the chat box. Start with a letter Q or question if you can. Make it easier for me. Or raise your hand in the Zoom chat if you know how to do that. And we'll be more glad, because I want to make it interactive. Let's go back a little bit though, Matt. You really broke it into two pieces, passive and active. Passive is where you find somebody else who has the project, you invest along with them and get a return for your money, ideally better than you might just in stocks or bonds, or certainly better than a bank account. And this is where, for me, this is my primary form currently of investment, where I feel like my business is real estate, and I occasionally flip some homes in the business, but I make more money than I live on, take the excess and put that into real estate for passive income through limited partnerships. I've invested in a couple, and so that's what I've done. And so I'm looking to do now with some more money. So talk about the investor who might have $50,000, $100,000. They might be accredited, net worth of $1 million or more, might not be, not worth $1 million or more. What should they look for? What would the next steps be? Learning how to vet the partner, learning how to vet the deal. Is the book the answer? Are there other places they should go? Other resources?
I wrote the book for that purpose, right? I mean, honestly, I make like $5 if a book gets sold. It's not a money maker for me, but it was something that I wanted to create for people to be able to learn about these things. There are other ways to learn it. There's information that you could find from going to a virtual meetup like what you're hosting right here, right now. There's also live meetups in certain areas that you could go to, right? You could go to meetup.com and look for one of those. But there's several forums online. There's YouTube channels and YouTube videos. There's a ton of other books too on real estate investing. And so the kind of things that I'm talking about with the multifamily, right, they're called real estate syndications. And I'm going to break those down for you in a second, but you could get those from books, and you could also join, there are places that have clubs and mentorship that charge money and sometimes tens of thousands of dollars, where you can learn these things, meet with others who are doing it. So it really kind of runs the gamut. I wanted to create a way where someone could spend, I think the Kindle version of my book is like $10, and just at least, know enough to be dangerous and learn enough to decide if they really want to go down and how far down the rabbit hole they want to go. Right. From a passive investment perspective, what I do, and well, both passive and actively, I'm doing syndications. And as an investor, I'm investing in these what a syndication is when a bunch of investors want to get together and purchase something, right? And it doesn't have to be real estate. There's a little thing that me and my wife do on the side. We do some Broadway stuff. We do some investing in Broadway, and Broadway shows, believe it or not, are set up as syndications. And there's basically two flavors of syndication. There are many, many other ones, but there's two primary ones that are used. And so one is called a 506B and one is called a 506C. And a 506C requires you to be accredited. There's a few different ways to be accredited. As you mentioned, the $1 million net worth. There's also some income thresholds and things of that. And there's a few different ways to skin the cat. But if a syndication is a 506C, it would allow the sponsor of the deal, to be able to talk about it in an advertised sort of way. As an example, I happen to have a deal right now. It is a 506C. We've got a couple slots left. It's an awesome deal in Fort Worth, Texas. So if someone wanted to invest in it, they could talk to me about it and we could see if it's right for them. They would need to be accredited, and that would need to get verified by a third party. So that's, one option. Most of the deals
So hold on right there. So to talk about that deal, they would have to be accredited and verified accredited before you can show them the numbers.
No. That's not a problem. I could show them the information, but I couldn't let them into the deal unless they were accredited. And that would need to be verified by a third party, by like a CPA or an attorney. And there's a few different ways that could be done. But that's a 506C.
So we've had it through a few 506C projects that have invited guests in to go through the numbers of the project just to kind of show what it looks like. But in all those, if you want to move forward, you need to contact me. Here's our portal, get accredited. And once we verify that that's the case, then we can allow you in the deal. But those are ones that you'll see sometimes go through the numbers online or, on a public setting kind of basis, right?
Correct. They could do that. They could go through it in a public setting. The 506B, which is what most of the deals that I do and most of the deals that I invest in actually happen to be 506B. The 506B, you can be accredited or you can be a sophisticated investor. And the sophisticated investor doesn't have any particular financial, thresholds, but it needs to be someone who understands the risks that are involved. Because there are risks, right? You could lose your money in these deals. They're not liquid. There's a few different things that people need to understand, and they need to understand how to look at these deals, which, hopefully you get my book and you understand all of that, right? But if you're a sophisticated investor, you could invest in these. The thing with the 506B is that you cannot advertise them or talk about them in a public setting. So if anybody wants to find out about my deals, and like I said, most of them are 506B, people need to establish a relationship with me, and they do that through joining my investors club. There's an online form, and then we have some conversations and we get to know each other a little bit. And then they are on my list to get my deal flow, right? So they could, there you go. So the investors club, there's an application online and you fill it out, and then we get to know one another. And then because we have that pre-existing substantive relationship, I can let you in. So if I had a deal right now that was a 506B, Bill, and you and I just met right now on this meetup, and you contacted me and you said, hey, Matt, I'd like to join your investors club. Do you have any deals? I could say, yeah, you could join the club, but I couldn't let you, like if the deal I had right now is a 506B, I wouldn't be allowed to let you into the deal. We have to have that relationship has to be pre-existing. So, generally they say, at least before the deal actually goes into contract. So if I meet you we develop that relationship, we get to know each other, and then a week later I sign a contract, it's fine. But if I had signed the contract on the deal the week before we met and developed that relationship, it wouldn't count. So that's the difference between the 506B and the 506C.
So anybody interested in working with you and interested in seeing your 506B deals, the non-accredited, they should go to the Investors Club, sign up, then they have a relationship, and then you can show them those deals and walk through that in detail.
That's correct.
And what's a typical minimum investment for your 506B product?
Yeah, so for either one, it really depends on the size of the deal. There's a certain amount of overhead for each person. Otherwise, heck, I'd let everyone invest only $1,000, but we'd have thousands and thousands of people to deal with. So depending on the capital raise size, that will help us determine what we're going to do. But it's usually somewhere between 50,000. We try to keep them as low as possible. So we try to keep them at 50,000. But sometimes if it's a larger capital raise, we might go up to 100 or somewhere in between.
And I think, now this is me speaking, I think it's a good practice to kind of pick a couple and try them out. Rather than put a lot, if you can get by, if you had a couple $100,000, let's say 200,000, this is my strategy. Rather than one, find four, because I hope to make more money this year, and I am, and next year and the year after. By spreading it out, I can see how each of the operators work, and they're all a little different. They all have different ways of operating. They all have different successes, and there's some of it's luck. But going down that low is fantastic if you have that much money or more. But of course, it's all relative. So that's the B product for non-accredited, and the C product, you don't have any current projects, so you can't really show us those numbers. What's a typical?
I do. I have a current project right now that I'm working on.
It's not on your website though, so you can't show that until you're in a contract. Or
well, no, it's in contract. We have a couple of spots left, and then we'll be closing on it at the end of the month. We could talk about it. I don't post anything on my website. The only things that I post on my website are projects that we've closed on that we're currently operating. I haven't closed on that deal. It's called the Crossings 820. I could show you some information about it if you think that would be of value to the group.
I think it would be. I think if people like to look at deals and numbers and actual, and maybe manage the numbers or numbers. Let me. So could I share my screen, Bill? Sure. Let me get you the permission.
You may need to make me the co-host, possibly.
There you go. You should be able to do it now.
Okay, cool. So let me, that's my family. Let me open up Crossings at 820.
That's not fair, man.
She's cute. Okay. So, all right. You can see my screen, right? So this is the Crossings 820. It's a 418 unit portfolio in Fort Worth, Texas. If you look at this picture in the right-hand corner, you can see the four properties. They're adjacent to one another. It's not like four properties that are spread out. They're all right there. We have one central leasing office where everything's going to be run out of. And, disclaimers. And I probably should have said this before I even started. Like, I'm not an attorney, so all that 506B and 506C stuff that I told you, you should probably chat with an SEC attorney about. I'm not a CPA. I'm not giving any professional advice, right? And when I'm talking about this deal, there are all these forward-looking statements that may or may not come true, right? We try to, vet these things as much as possible, but these are projections, right? But here's the executive summary, and if you want, we can go into detail. This deck is how many pages is this? It's about 50 pages. I don't want to bore everybody. But we're buying this property at $54.6 million. We're going to be raising a little under $16 million of equity. Our plan is to hold the property for 5 years. The average cash on cash over the 5 years, if you look at it, it starts lower, it ends higher, but the average is 8.36%. And so the total return on investment on the deal after sale is going to be 94%. And the way we come up with that sale value at the end is by looking at the cap rate. So this is one of the many, many different things that I talk about in the book. But I'm sure a lot of the people who are listening to this, who are on in your group, understand this. They're a bit sophisticated, right? Where the cap rate at reversion, that's the exit cap rate. that's going to determine the value. So all commercial property the value is determined by the net operating income, so your income minus your expenses, divided by the prevailing cap rate in that area. That's how you come to your value. So we're buying things at around a 4 cap nowadays. And this particular—
Isn't it amazing to say that out loud? I remember when cap rates went below 10 in Beverly Hills, it was like a riot in the real estate office that people consider buying property in Beverly Hills, A-plus properties at below 10%. And here you just said Fort Worth, Texas, where, unless you're from Texas, you probably haven't been to Fort Worth. It just rolls off your tongue. We buy at 4%. I'm sorry, just had to jump in on that. Go ahead.
That's okay. That's okay. Fort Worth's actually great. The Dallas-Fort Worth Metroplex. We can talk about it in a second. Actually, I've got some great slides on it to show you the amazing growth that's going on there. And that's one of the reasons why the cap rates are low, but they're compressed across the entire United States. Right. But when we look historically,
I don't mean to disparage Fort Worth. I've been there and it's lovely here. I'm just saying it's not like
it's not
Paris,
Beverly Hills.
Beverly Hills, Malibu, where
Sure.
This is like the most fine real estate in the world. Fort Worth is a working class, solid city, great economy, but 4% cap rate. You would have thought people thought you were crazy 10 years ago to even think about investing at that rate of return. I'm sorry.
Yeah, I would agree with you that the cap rates have gotten really compressed. So what we like to do is look historically at the submarket and see where, and this is one of the things that I talk about in the book. It's like, hey, I look historically at numbers. So our reversion cap rate for this is 5% because that's historically what we've seen in that area. And the IRR on this deal, so the internal rate of return, so that is your return including the cash on cash returns that you get during it, is a little under 16%. Usually my deals, the IRR is somewhere between 14 to 16%. And then the way that this deal is structured, 70% of the ownership is for the members, right? And I'm a member. I put my own money in these deals. Like I said, I invest 2/3 of my deals are deals I invest passively in, but I invest in my own deals too. And I want my own deals to be as good as the criteria that I have for my passive investments. So 70% of the ownership will be for the investors, and then 30% for the ownership group, for the sponsor group. We're providing an 8% preferred return, and it's a return on capital versus a return of capital. And then we have an acquisition fee and an asset management fee, but no exit fees, no refinance fees or anything like that. There's a 418 unit property, like we said, in Class B area. The household income is $78,000, which is actually really good in a 1 mile radius. It's better than a lot of the properties that we acquire. And the rents are way below market. So we can go ahead and improve that community, improve the interior of the units as well as the exteriors, and bump those rents up to the middle of the market, and make a nice return. So that's basically that's the executive summary. I mean, I can go into more detail, but I wasn't, I'm not planning on pitching this offering in this call.
Well, let's go into a little bit of detail. So 54 million approximately on 418 units approximately is about $125,000 a unit.
Yeah, I think it's $133 a door.
Yeah, about that per door.
Yeah.
Which sounds incredibly cheap to somebody here in Los Angeles. And then when I look at the rate of return, you're talking about the total rate of return projected. Now, these are projections and disclosures, but I'm just saying, just imagine this as a hypothetical investment even, that you're talking about almost doubling your money. 100% return would be you get your money back and 100% of your money. This is 94%. So you're not quite doubling your money, but you're getting pretty close to doubling your money as projected over a 5-year process, correct?
Yeah, that's right. That's right, including those cash on cash returns that you get.
And so the plan here is that you have the property. Are you doing substantial capital investment, or is it really just stabilizing and raising the rents on what you have already?
We'll be spending about $2 million in capital improvements throughout the property. So that's, one of the things that we talk about a little, we go over the business plan, but then we have some data on how great. Ooh, my watch.
Siri's always interested in talking.
Yeah. We
so
have
$2 million on a $54 million investment, that's less than 2%. So it's not it's not a huge amount of money. You're talking
Right.
about,
It's about $5,000 per unit.
you wouldn't call this a value add as much as maybe a refresh or a,
I think it's a value add. It's just a light value add. It's not I wouldn't call it a heavy value add, but we're spending $2 million is $5,000 a door. It's usually pretty good. I mean, we're usually spending somewhere between $3,000 to $6,000 a door, depending on what we're doing. We're not ripping units down to the studs. I mean,
Right.
if you look here, you can see here's what one of the current units look like. And this one's actually already been partially upgraded,
Yeah.
but we're redoing the cabinet faces, right? We're doing two-tone paint. Usually a lot of the paint is beige. We're going to go to a gray. We're doing stainless steel appliances. We're resurfacing countertops. So we're doing some work, but not we're not moving walls or ripping things down to studs.
And the updating, is this reflecting an increase of average income in the market, or just the market requirements are higher quality than they were in years past?
In terms of like, why are we making those renovations?
Or that level of renovation, how did you determine?
Yeah,
those
I mean,
levels of-
we look at the competitive set in the area, right? So like, here's where our property is, and we look at the competitors, right? We understand what the competitors are charging for their rent. And then we look at what we need to do to be able to achieve that, because all the properties that we're buying, when we're looking at them, we're looking for properties that have not been updated where the rents are at the bottom of the market. So then we take a look at it, we say, okay, well, what's the variance? Why are we at the bottom of the market? Oh, well, they all have stainless appliances and we don't. So if we get stainless appliances and then everything else is the same, then we should be able to get the same rents they're getting, right? So that's a really, really rudimentary example of how we're determining that information. And then we have a whole financial analysis that we go through, and we do a whole break-even occupancy, right? And so we're looking at all of these numbers and figuring out where projections are going at. Are rents going to increase or decrease? Where do they stabilize out at? What's our economic vacancy? What are our expenses? What are the new property taxes? I mean, these are all different things that we're taking a look at to determine where we think things can go with the property.
Do you do a cost segregation analysis on your purchases?
We do a cost segregation study. So here's a cap sensitivity study that we also do, because exit cap rate can change and that can change your return. But yeah, we actually had Green Summit come out, take a look at they didn't come to the property. We didn't pay them to actually conduct the cost segregation study, but we got an estimate from them based on the offering memorandum and their information, and they've done a number of properties in the area. So they're estimating $17 million eligible for that bonus depreciation, and we're raising a little under 16 million in capital. So it would be over 100%. So if you invested $100,000 in this deal, it's very likely that you would get, and it's an estimate, so it could be off a little bit, but it's very likely that someone would have a passive loss in the first year of ownership of over $100,000.
Yeah, and I think that's one of the hidden values of these syndication deals is, I know the advantage of owning individual properties is clear when you see a tax return. I invested in a syndicated deal in December, and that deal I put in $50,000, and they had a cost segregation analysis, and I got a deduction of like $43,000 or $44,000, which meant in hard cash, my tax bill went down by just about $9,000. So of my $50,000 investment, I already got $9,000 off my tax return. If the $50,000 evaporated, God forbid, I already got $9,000 back. Now I hope to get a return and eventually a profit, but it was a fantastic way. It's a great way to, I think, limit your losses or to hedge some of your risks in the process.
Yeah, I mean, the only thing I would say is that, it is a passive loss. So people should check with their tax preparer because there are certain rules around all of that, and everyone's tax situation is different. Right. But in most cases, there's definitely an advantage there from a tax perspective.
Yeah, it worked for me. I was happy. Okay, a couple questions, and I'm pausing your hand up too, but good question. Christopher asks is, do you vet sponsors that may or may not have pre-2008 experience, or because I know that a lot of people got in the business the last 10, 12 years. They've only seen one type of economy. They try to stress test their analysis for 2008, but there's a difference in having lived through that and having struggled through that. Do you vet that? Is that important to you in your process?
It's not important to me in my process. I lived through 2008 with my own personal real estate, but I did not have, I didn't have a syndication business. But, if you're limiting yourself to people who were, I mean, you're going back to people who were in business that had to be in business in 2006, right? To sort of like live through that 2008. And that's
Right.
what, 15, 16 years ago. I mean, I haven't been in business for 16 years. So you would be limiting your playing field. There's nothing wrong with doing that. I mean,
Right.
if that's your criteria and that's what makes you feel comfortable as an investor, then by all means do it. That's not what I do, but I do want to find people who are looking, for cap rates. Let's just talk about cap rates for a second. Exit cap rates, as you saw in that cap rate sensitivity study, can really drastically affect the return that you can have on a deal. And some people are saying, oh, well, I'm just going to increase the cap rate by 50 basis points because somebody told me you're supposed to do it 10 basis points every year and it's 5-year hold. So we're going to increase it 50 basis points. I see a lot of people underwriting deals that way or saying, oh, real estate's strong. We're just going to keep the cap rates where they are. I think that's very risky. That's why I try to look at, okay, what is the historical norm in that submarket? Historically, we see cap rates at X amount. That's where I'm going to move my cap rates to on exit. And so in this case, it's a 75 basis point increase because of this particular submarket. But the deal I did before that, we bought at a 4 cap and we said we're going to sell it at a 6.25 cap. Remember, as those numbers go up, it means the real estate market is softening. So I'm already underwriting, and the deals that I'm investing in are underwriting for a softening in the market. I feel like if you're doing that, you learned the lesson from 2008, whether you lived through it firsthand or not.
Well, I think for me, having lived through it, suffered through it, I would say I can diversify my investments, and as long as there's cash flow, what I learned in 2008 was if there's no cash flow, you have a gun to your head.
That's what I learned in 2008 too.
If you have a project that you're building and development projects are great and they all pencil out and they all look good. You're going to build a hotel, you're going to build condos, you're going to build a fourplex, whatever. But if the market changes and you're halfway through the deal, you're screwed. There's no cash flow. And you have to sell it into a retail market. The prices are dropping, very difficult to do. Here, as long as people are still paying rent, rents have never gone down in America. Even 2008, rents didn't go down. So as long as there's cash flow and there's a team that knows to refinance the loan so they're not stuck having to sell it at a bargain price, you're okay. It's where you get caught in the middle is where I think what I saw people got destroyed were they bought a project like that and they were redeveloping half of the project halfway through 2008 and ran out of money.
Yeah, Bill, two things on that. So number one, multifamily's done really well in 2008 and also during COVID. But in 2008, people were losing their homes, but they still needed a place to live. Right. And so they were moving into apartments. Right. And then during COVID, people were not working in the office. They were working from their apartments. So, I'm not saying it was unscathed, but it wasn't hit as bad. But the other thing is exactly what you're saying. Keystone concept number 5 in my book is cash flow is king. Because if you have that cash flow, you can ride out the inevitable dips that you're going to have. Right. The markets, the real estate market is a cycle. It's going to go up and it's going to go down. If you've got cash flow and you can make your debt service payments, you're good to go.
Yeah. One of the questions Kevin asked is who gets the $1,092,000 asset management fee? So in the scenario you just showed in Fort Worth, who's the manager who's getting the asset management fee?
Yeah, so the asset management fee, just to be clear on the vast majority of these deals, the way that we've set them up, and you have to read, there's not a lot of hard and fast rules in syndication. You have to be SEC compliant, but you can set deals up in different ways. All the deals that I invested and that I sponsored, the asset management fee is a fee off of the income coming in. So on a monthly basis, based on the gross income that has come in, we take that fee. And that goes to the asset managers. I mean, honestly, it usually ends up to be, we have a few different people involved in the deal. I mean, it's like $20,000 or $30,000 a year that I make from asset management for each property. It's not like I'm in, and I have staff, that I hire to work on these things. So it covers them, but I'm not making millions of dollars off the asset management fee. Where I really make my profits are when we sell a deal and we pay the investors back their full capital, their full investment. Once they've got 100% of their investment back, then we have that split, right? And so then those profits are split, and that's where I will make my money. So if a deal is not successful, I don't really make any money off of it. I mean, I do have income coming in, but I have a ton of expenses because of the operations. This is what I'm doing full time.
Right. No, I want to look at the Fort Worth deal offline. I'll have to reach out to you. Okay. And I know, Paul, you're patient. You had your hand up as well. Let me see. Let me unmute you.
Hey, Bill. Thank
Paul,
you.
Yeah.
Hi,
Here's
Matt.
Now, Paul, just for those who don't know, Paul's an investor in multifamily. This is a guy who knows his stuff. So I'm anxious to hear what you have to say, Paul. Go ahead.
Oh, no, I'm worried.
Not to oversell you, but go ahead.
No problem. Hi, Matt. So thanks for the information. That was a great presentation. And the question I had for you is, I saw your per unit investment, and then just a quick kind of like survey of the projections that you did in your financials. So when you put in a certain number of dollars, 34, 44, whatever the number is, are you thinking about it in terms of just hitting your so that you can pay your pref to your investors and make sure that, hey, the amount of money that we put in will ensure that we're always able to hit the pref so that the investors are happy? Or are you thinking in terms of like a target repair value, asset value, because you want to at some point refinance with some long-term debt? Like, how do you, because 3,400 in my world would be a really small investment. So I was just kind of curious, how do you arrive at
3,400 per door
right
on the interior renovations for that property? 70% of the units have it changes per deal. On this particular deal, 70% of those units have already been renovated. They're just not a full renovation. So we feel, based on what we've seen from, we walk every single unit. We've done an audit of the entire property, well, all 4 properties, right? We feel that putting in 3,400 per unit is going to get us to be able to bring the level up to where the competitors are in the marketplace. It has nothing to do with the preferred return. The way that I approach all of these deals is I take a look at what I need to do from a value add perspective to get to the place in the market where I think that we can bring the asset to, and then determine what those rents are going to be. Based off of that information, I have certain thresholds that I want to hit for my investors in terms of their returns, and I just adjust the sales price until I get to the highest possible sales price that's still going to meet those return thresholds for the investors. And that's my offer. And a lot of times I don't win the deal.
Right. Well, it's competitive.
Yeah. But that's how I approach it. Not really trying to determine a future refinance type of event. I actually just had a blog post that I posted this morning about refinancing, and I see all these deals now that have this magical refinance in year 3, and I say, how do you know what interest rates are going to be 3 years from now, or what valuation? Oh, there it is. So I think refinances are great. Don't get me wrong. It's actually keystone concept number 18, right? Refinance when you can, just do it responsibly. But I want to see a deal, and all of my deals will work on a 5-year deal with no refinance. And then if we can refinance, we're always looking at the market. Sometimes we exit early, sometimes we refinance, just depending on what the market conditions are. But I want a deal that I know that I'm going to go in and I've got a 5-year plan. And if we execute the plan in 5 years, we'll do very well.
I gotcha. I mean, everyone has a different strategy. I was just curious how you arrived at yours, because I heard A-Rod talk at the EXP say that he does a 10-year and he does 10-year IO, and in my world I go for 12-month because I'm going for the maximum value. So I can't put $3,000 into a property and get enough value out of it. So it's just interesting to hear how you're arriving at it. And what it sounds like to me is that your 5-year projection is really more of like where you work around how much money you have to put in to get to market. And then, okay, if 3,400 is the magic number, now that number, it should get you pretty darn close to market, and then you let it ride for 5 years. Is that fair to say? Or?
I think that is fair to say. And it'll depend on the unit, right? It'll depend on the property. It'll depend on the class of property, right? If I was buying a B plus versus a C minus, my rehab budgets might be very different, and depending on the conditions of the unit, and depending on what the competitors in that marketplace are doing. But yeah, the idea is to go in, do the renovations, both interior and exterior, try to execute as much as we can in the first 12 months, but inevitably it takes about 24 months to do it. And then, it takes a while for tenants to turn over. We don't go in and, all the properties that we're buying are stabilized. So they're 90% occupied, right? So we're not going to go in and clear house and have our vacancy go down. But through natural attrition, we see about 30, maybe 25 to 50%. It really depends on the property and the location. Of attrition just naturally. So it usually takes about 3 to 4 years to kind of work your way all the way through that rent roll and have all new tenants. And so we just do that gradually over time. We don't, one of the things about my business and the way that I run my business is I try to make the world a little bit of a better place. I'm trying to reinvent property ownership from this, it gets a really bad reputation, I think, especially by the media. And I'm trying to reinvent property ownership as a positive for communities. And so we never want to kick people out of their homes or push them out by increasing the rents too much. And we do those things, we improve, but we usually make those improvements as people just naturally don't renew their lease because they've bought a house or they moved to a different place or whatever it is. That's when we'll do that renovation and increase those rents.
Gotcha. Okay, great. Thanks, Matt.
Sure.
So we got a question from, I think it's Ketchy. Let's see here. So what are your thoughts regarding predicted recession in real estate market in the next year or so? I get asked this now daily. I do a video on it once a week. But what are your thoughts, Matt, as far as?
Yeah, so there's been a recession coming for the past 8 years, right? I've been hearing next year or the next 2 years there's going to be a recession, right? Been hearing it for a very long time now. And so just like the refinance, I don't know when there's going to be a recession. Like I don't have a crystal ball. And so there may be a recession in 2022. There might be one in 2023. I mean, logically, if you look at everything, does it make sense that there could be a recession this year or next? Sure. But I also felt that way a couple of years ago, right? I also felt that way as soon as COVID started. I was like, okay, well, now we're going to have that recession, and it didn't happen. So I know that I can't predict the markets. That's why, like you were saying, Bill, I'm all about cash flow. If I have that cash flow, I can ride out those dips in market cycles. So I look for properties, which are businesses. I'm looking for businesses that are resilient, such as multifamily, because people will always need a place to live. And I look for businesses that are profitable. And so with that cash flow, we have that cushion. And that's one of the things in the underwriting, right? We show a break-even occupancy on this particular deal. In the first year, we could go down to 60, I think it's 67% occupied and still be able to make our debt service. Don't quote me on that. I'm just trying to, if I had it in front of me, I could.
There's some room there. There's some cash flow and there's some room.
No, there's room, right? So that cash flow also will allow you to, let's say you have to have concessions. Let's say you have some bad debt. We underwrite for that. We already anticipate for that. But if it's worse than we had anticipated, so your cash flow, maybe you can't give your investors a 10% distribution. Maybe it's only 5%, but guess what? You're in the middle of a recession. I mean, I'd be happy with 5% distribution in the middle of a recession, quite honestly. So,
just because I was an economics minor in college, the definition of a recession is 2 consecutive quarters of reduced rate of growth, meaning if the company's growing at 5% a year, if it goes one quarter to 4.5 and the next quarter to 4.25, technically that's a recession. Last quarter we went down 1.25% or 1.4%. So in some regards, this last quarter could be worse than a recession in terms of the adjustment. Now, what does it mean going forward? I don't know. It's very hard and very murky in a lot of international politics and changes. But I think, the fear of recession, I think, is healthy. It forces people to be reasonable in their bidding and in their numbers. Absent that, people would just continue to leverage like 2008.
Well, and the other thing is when you think about 2008, when people hear recession right now, there's sort of that recency bias, right? Everyone thinks, oh, recession is going to be 2008. Recessions usually aren't as bad as 2008. That's why it was called the Great Recession, right? They're usually not that bad. They're not great. I'm not saying that they're good or a walk in the park, but I think the odds that it's going to be as bad as that one was, I don't know. I'm not a betting person, but I imagine that it's not very high odds that it would be as drastic. Yeah. But again, all of our underwriting, we try to be conservative and take an approach of, hey, things are going to soften up in the market. So hopefully we've done our job and we've baked that into the underwriting. But we don't really know until it's over and we'll know what happened and we'll find out.
We'll know. Sean Burke, you have your hand up and you're unmuted, ready to go. Sean's our magic photographer and he also sponsors our show and some of our programs. How you doing, Sean?
I'm great. Hey, Matt, I got a question. And I know Southern California numbers fairly well, but you're talking Texas and, going across the U.S. Is, the recession, technically, instead of 5%, we're growing at 4.25 or whatever. But some of the stuff I'm looking in different factors, like here in Southern California, something like 300 houses or doors or however you want to phrase it could fall out of the sky tomorrow. And then we're going to still need another 30 grand next month because of the shortage. So plus the fact everybody's got way more skin in the game than in 08 is, a manufacturing recession, in a inventory reduced environment like real estate currently. Unless a bazillion houses fall out of the sky, I don't see it for a couple of years until the inventory itself quantity stabilizes.
Yeah, I don't know when the inventory stabilizes in terms of like a couple of years. It depends on the growth. If you look at the demographics of Dallas-Fort Worth Metroplex, like the growth and the demand for housing is massive and it's continuing. More and more employers are moving California, and New York. Okay, I live in New York, and moving to Texas, right? And so you've got, more and more growth, just unbelievable growth, employment growth, which has people move for jobs, right? People move to where the jobs are. And so I think there will be a demand for housing. Now, if there is a recession, the question is, okay, maybe rents stagnate, maybe rents don't grow. People need to be making the money to pay the rent, right? But I do think, I think multifamily is a great place to be in a recession, just as an asset class. And I think Texas is a great place to be in terms of the growth that's gone on there. So hopefully, like in 2008, Texas multifamily didn't get hit as bad as the rest of the country. Hopefully it won't get hit as bad. I'm not saying it's not going to take a hit, but I hope that it, all signs point to it not being that bad. And then there's a lot of good things going for it. And also, if you look at like the recovery, like when you look at COVID, I have a chart in there about just kind of like the recovery of the country. And the recovery in the Metroplex was way up there. It recovered faster than the rest of the U.S. And so, hopefully it would be able to do that in a recessionary environment as well.
All right.
Thank you.
Thanks,
Sure.
Sean. And Sean's contact info on the screen. We got a question from the YouTube, from the live chat. Let's see here. George, we'd be open to getting an estimate from another cost segregation firm, Matt. Looks like George works for CSSI. So I'm sure the answer is once you get the deal, you're very open to it.
Well, we have the deal. We have the deal.
Oh.
We'll be closing on the deal later this month. I mean, it's under
Okay.
contract, so
Right.
that's not a problem. I'll tell you just honestly, George, if you want to reach out to me, that's fine. We have a few different cost segregation companies that we already have established relationships with. And I'm not the kind of guy who just like jumps ship on someone every day for the next, I like to have relationships and longstanding business relationships and business practices with people, but I'm always open to meeting people. So let's connect and see where things go.
Very good. The fact he's here today is living proof. Last question of the day. Dave Weinderman, always glad to have you on. Let's see, get you unmuted and get you into a call.
Thank you, Bill. And thanks so much for your, what a great guest. Forgive me, I'm with my phone and I don't have the name, so I am a little bit embarrassed, but I am not harmful. I'm harmless. But my question is, what do you think about the concept of stagflation and whether or not that is potentially in the future cards?
I'll just jump in and give a quick piece of information. Fannie Mae, their economists, that's basically what they're projecting, that we'll have inflation that will hurt the economy and will cause loss of growth, but the real estate will hold up well because of the inflation and pent-up demand, and so that they would expect housing to outperform a stagnating or recession economy overall. And I see that because there's no foreclosures happening, there's no delinquencies, hardly any. There's no houses to sell to go into foreclosure. So I can see that it's hard for the housing prices to go down while the economy might be slowing down a bit and inflation is still behind us. Matt, what are your thoughts? Stagflation, or again?
Yeah, I mean, again, I'm not here to pontificate on what's going to happen because I don't know, right? I think that's the most honest answer anyone can give. But stagflation, right? That's where we have inflation, but where job growth, like wage growth, is stagnant, right? So that would hurt us from our business plan to an extent, because we wouldn't be getting that sort of rent growth that one would necessarily hope for. Possibly, it might be difficult for residents to pay increases. So maybe our rent increases aren't the same. But I also think in an inflationary environment, just through the magic of inflation itself, the asset price would rise. So my guess, is that
This is being recorded and put on all social media forever and ever.
We would be pretty much the same, as what I'm thinking would happen. I mean, it depends, it's such a general term, like how much is the inflation and how stagnant is the growth, and that I don't know.
You make some good points, and forgive me for interrupting, but the definition that I'm looking at right here on my screen is high inflation, of course, as you talked about, with high unemployment and stagnant demand. So the high unemployment could be attributed in some respects to the technology of our society that is going to displace, unfortunately, less skilled workers in parts of our economy. It's just, I believe it's the future, part of what we should be expecting. And it's going to be tough time for those folks that don't have the skills to get beyond that. And we're going to have to do what we can to help them as a society, for sure, and help them get beyond that. Not just handouts, but help them. So it's that high unemployment that is not, I think, going to be, as far as I'm concerned, so much unforeseen. And stagnant demand is what it says here. Which doesn't necessarily talk about real estate, but stagnant demand for goods and services in society.
Sure. All things being equal, right? That would have a drag on the entire economy, right? The entire everything in the United States, right? Or maybe globally. I think that real estate has, over time, like since the dawn of time, proved to be an asset that is important, right? And that people hold value to. So I do think real estate would still hold value. But if you're talking about massive unemployment across the entire United States, I think that all investments and the entire economy would take a blow. So, but I guess the question is like, would real estate take an uneven blow compared to the stock market, for instance, right? I think the stock market might lose more value than maybe the real estate would. But again, this is a little bit of, let me look in my crystal ball and see what's going on longer term. I agree with you that we are seeing more automation and things of that nature. So that is going to be a continuing trend. I don't know how that plays out in macroeconomically.
I tell people I don't have a crystal ball, but you can buy one on Amazon for about $70.
Oh, maybe I should get one, Bill.
Well, no, because I always tell people I don't have a crystal ball. Once you buy one, then you forever have to tell people you have a crystal ball. You have to answer those questions, but I'd rather not have the crystal ball.
But I can say that my crystal ball is cloudy right now.
There you go. Okay, so we're going to wrap up because our hour is up. Matt, it's been a pleasure having you on today. It was a pleasure meeting you and seeing you now for the third time here in the last couple of weeks. And I want to just direct everybody, if you're interested in more, his book, if you're interested in his investment club, taking a look at investments like the one he showed us today, you can check out Matt Picheny. How do you pronounce it? Picheny?
It's Picheny, actually, yeah.
Picheny.
Yeah.
Are you Italian?
No, actually, my grandfather was from the Ukraine back when it was part of the USSR. He escaped from there as a very young child and moved to New York. The name was pronounced differently back in the day, but at Ellis Island, they made it. Sounds Italian. I wish I was Italian. I love Italian food, but
I love Italian food too.
Yeah.
I'm Jewish, but yeah, my family also was Ukraine, was USSR. So Matt Picheny and his website, picheny.com. You have the book, your investment club. If you're interested in more information, he has a blog as well, a wealth of information. Thank you so much for being on our call today, Matt. I really appreciate your time and generosity of spirit. And for those of you on the call today, thank you so much. We do this every Tuesday, realestateinvestingzoom.com, realestateinvestingzoom.com every Tuesday, 3 p.m. Pacific, 6 p.m. Eastern. We live stream it on YouTube and Facebook, and we also record it there. Thank you so much, everybody.